Seagate is no longer trading like an old hard drive company. The market is now treating it like an AI infrastructure winner. That is a massive change. For years, Seagate was seen as a cyclical hardware business with weak pricing power, brutal margin swings, and long-term obsolescence risk. Now, the thesis is different. Investors are betting that AI-driven data center demand has structurally changed the hard drive market. And if that is true, Seagate could stay far more profitable than almost anyone expected. If that is wrong, this stock may already be too expensive. The business has clearly improved. Revenue is accelerating hard, with strong data center demand becoming the main growth engine. Margins are the real story. Gross margin hit record levels around 47%, and operating margin moved above 37%, far stronger than historical Seagate cycles. That matters because Seagate runs a heavy fixed cost base, so better pricing directly boosts profitability. Free cash flow is also improving sharply, helped by stronger operating leverage and disciplined supply. The biggest shift is that this no longer looks like a classic boom and bust HDD recovery. Management and analysts now think AI storage demand may be creating a longer structural upcycle. If true, earnings power is much higher than the old market expected. This is not a cheap stock. At roughly $795 versus a fair value estimate near $680, the market is already pricing in optimism. Investors are not paying for today's Seagate. They are paying for years of elevated pricing, expanding margins, and sustained AI-driven storage demand. That is the key distinction. The current business is strong, but the valuation only makes sense if Seagate grows into much bigger earnings and proves this is a structural re-rating, not another cyclical spike. If margins normalize faster than expected, valuation becomes harder to defend. Seagate is becoming an AI-era storage infrastructure company built around high-capacity Nearline HDDs, not a legacy PC storage vendor. Strategically, that is logical. Data centers still need massive low-cost storage, and HDD remains much cheaper per terabyte than SSD for cold and nearline workloads. Seagate is leaning into HAMR technology and larger capacity drives to improve pricing and operating leverage. The strategy makes sense, but it is risky because the company is concentrating even more around one thesis, that HDD remains critical inside AI and cloud storage ecosystems for years. The real battle is mostly against Western Digital, with Toshiba still smaller and less dominant. Seagate appears to have a slight edge in HAMR adoption and high-capacity drive roadmap execution, which could help near-term share gains. But this is still close to a duopoly, where long-term tech parity is likely. The deeper threat is not just direct HDD rivals. SSD economics keep improving, and companies like Micron can indirectly pressure long-term storage economics if flash pricing narrows the cost gap. Seagate is strongest in enterprise nearline storage. It is weakest where storage becomes commoditized or where flash replacement accelerates. The biggest risk is simple. This may still be a cycle dressed up as a structural story. If AI-related data center demand slows, pricing weakens, or supply discipline breaks, margins could compress fast. Seagate still has no real economic moat, which matters because this business historically struggled with pricing power. Longer-term, SSD cost improvements could attack HDD relevance. The thesis also breaks if HAMR execution slips, hyperscaler demand softens, or investors realize they paid growth multiples for what is still a hardware-heavy cyclical company. That is why this remains a high uncertainty stock. For this stock to work, the HDD supercycle must be real. That means AI workloads continue exploding, hyperscalers keep buying nearline storage aggressively, pricing per terabyte remains firm, and Seagate keeps converting that into structurally higher margins. Success would mean Seagate proving this is no longer a weak commodity hardware business, but a more disciplined infrastructure supplier with stronger earnings durability. If that happens, the market may still justify premium multiples because the company would have permanently higher cash flow power. This is no longer a boring dividend hardware stock. Seagate is now a high-risk AI infrastructure re-rating story built on one critical assumption. Hard drives still matter much longer than the market once believed. That can absolutely work. The financial improvement is real. But this is not for investors who want stability or cheap valuation. This is for investors who believe AI demand is strong enough to structurally rewrite an old industry. If the supercycle is real, Seagate still has a path higher. If not, this stock may be pricing perfection. I'll break down the next one soon. Subscribe if you want to stay ahead.